If you are a high income earner like me, you probably wonder, how can you reduce your tax bill? In this video, I'm going to teach you how you as a W-2 earner can creatively reduce your tax bill. If you're a physician, an executive, or high earning professional who feels like you are just working entirely too hard to hand over half of your check to the IRS, then this video is for you. And we're not talking about the basic stuff because I've already covered that in this video here. I'm giving you the strategies that most people have never heard about. These are things like oil and gas write-offs, short-term rental loopholes, how you can use businesses to slash that tax bill while building wealth. So grab a notebook and let's get started in the 8 creative legal ways to save on taxes. And the first is oil and gas. This is something that we did last year that saved us $25,000 on our taxes. Oh my gosh, I can't believe that it worked. It worked. I want to tell you about one simple money move that I made with our taxes this year to save us $25,000. I know, $25K. You're probably like, Brittany, why do you have to pay at least $25K? It was more than that. So I'm very grateful that I came up with this. And if you want to learn exactly how we did that and how the numbers work out, then you can watch this video right here. In this video, I'm going to give you a quick overview of oil and gas. And it's one of the least talked about, but incredibly powerful strategies. When you invest in certain oil and gas partnerships, you can deduct intangible drilling costs in the year that you invest. So that can mean 75 to 85% of your investment can be deducted from your W-2 income. Here's why that's special. So when you think about how you can use tax deductions to your advantage, you have to think about the character of that tax deduction. So let me explain what I mean about character. The IRS has designated that active losses can only offset active income. So say, for example, you have some type of passive source of investments, passive source of deductions, then you cannot use that deduction against your active income. I recently was on a call with my friend. He literally texted me and said, Brittany, my tax bill has not changed at all. The real estate properties have not helped a bit. And I had to explain to him that because he was not a real estate professional, meaning that he was working 750 hours within that year as a real estate professional, then he could not deduct his real estate losses for his long-term rental properties. So you must think about what type of income and what type of losses are these. When you are a W-2 earner, you are the least advantaged when it comes to implementing tax strategies. And that is why this video is so critical. And you definitely want to stay until the end because I have a bonus strategy for you that I am considering right now. So when you think about oil and gas, what makes them so special is that these deductions are not subject to passive activity loss limitations. That's right. Even as a passive investor, you can reduce your active income. Plus, you get a little bit of a pass-through deduction or depreciation deduction on all of the future profits. Now, a caveat. These investments, just like all investments, carry risk. So you want to ensure that you do your research. And I have a video upcoming about how to look for oil and gas opportunities and how to vet the general partner and that company before choosing oil and gas. So if you want that video, then you want to subscribe to this channel, hit the like button so that you can get the notifications when that video drops. Now, the next opportunity that I hinted about is short-term rental properties. And this is with material participation. It allows you to take advantage of this short-term rental loophole. Short-term rental properties where guests stay on average less than 7 days are not treated passively if material participation requirements are met. So that means you don't need to qualify as a real estate professional or get rep status, which is hard to do if you are a full-time employee. With this loophole, you can use the losses from your short-term rental property to offset your W-2 income. So let's say, for example, that you buy a $600,000 vacation rental and you do a cost segregation study. Now, a cost segregation study basically means that you take that property besides the land, but you take everything in that property and you hire someone to break it down to their elements. So it might look at the physical building. It might look at some of the appliances that you have within the building. It allows for you to depreciate each and every component over time. Now, every cost segregation study needs to be individualized for that particular property, but you might be able to deduct $100,000 plus in bonus depreciation in the first year alone. Now, that's a huge boon for some of us who pay more than $100,000, yes, me, in taxes every year. It can reduce your taxable income significantly. To qualify, there are some requirements that you must meet. So to put it simply, you'll need to put in around 100 to 500 hours into this property or all of your short-term rentals, depending on your investment. And you also need to have more hours than anyone else. So if you have a cleaning lady, if you have a contractor, if you have someone who's a designer or is stocking the refrigerator, you want to make sure that you have more hours in the property, working on the property and in the business than anyone else. The third way to decrease your tax bill is through bonus depreciation on rentals using cost segregation studies. So even if your rentals are long-term and you are a passive investor, there is still some gold there. A cost segregation study breaks the properties into the components, as I mentioned, like plumbing, fixtures, appliances, which can be depreciated over 5, 7, or 15 years instead of 27.5 years or 39 years if it's a commercial property. So if you combine this bonus depreciation, which allows you to write off all of those components in year one, you've got a huge upfront deduction. So say you own multiple long-term rental properties, then this will allow you to offset that passive income that you might be accumulating by taking this cost segregation and bonus depreciation for those rental properties. This strategy is even more powerful if you or your spouse can qualify as that real estate professional. So this is one of the things to think about. If your spouse is working part-time, then maybe they can go for rep status and help to reduce the tax bill and use those long-term rental properties to reduce your active income. And number 4 is Section 179 and bonus depreciation for business owners. So let's talk about starting a business and let's tap into this Section 179 and bonus depreciation. If you purchase equipment like a business laptop, like a camera, medical devices, or even a 6,000 plus pound SUV, you may be able to deduct 100% of that. Yes, 100% of that in the first year. This is especially useful for high income earners starting consulting businesses, speaking businesses, coaching businesses on the side. Another thing that you can do if you have your business, which takes us to number 5, is using the home office deduction. So usually I talk to women in healthcare, and I know a lot of women in healthcare have 1099 income. If you work for a locum tenens company, or if you're travel nursing, or you just have your side hustle. Why not use your office in your home for your business? And if you run a legit side hustle or business from your home, you can take the home office deduction. So that includes a portion of your rent or mortgage, utilities, internet, insurance. This deduction is only available to self-employed people and not W-2 employees. But listen, you can start a business very, very simply, okay? It does not take much to start a business and start to produce some side income. You can, in fact, ask your current employer if this is something that you want to do, or if you're working for multiple hospitals, ask them to transition your W-2 income to 1099 income. Now, with that, you become self-employed and you might lose some of the benefits. So you have to weigh out the drawbacks of making this decision, but it allows you to take many deductions. And number 6, invest in active businesses that own real estate. You can also reduce your taxes by investing in businesses that own commercial real estate. So let's say that you buy into the med spa or the surgery center or a co-working business. If that business owns the building, you can use your share of the commercial property depreciation to claim losses on your K-1, especially in that first year. It's a creative way to combine business equity and real estate tax benefits. And the next one that we're going to talk about is charitable giving strategies. Now, if you're charitably inclined like we are, we give 10% of our take-home pay to our church every year while also investing in other nonprofits whose missions align with our values. You don't have to just write checks. You can use strategic giving and donor advised funds to front load your giving in a high income year and take a big deduction now while giving over time. Charitable remainder trusts also reduce taxes today, and you get lifetime income and leave the remainder to charity. So you can do this by donating appreciated stocks to avoid capital gains tax. And the 8th is Roth conversions in low income years. If you ever take a sabbatical, going part-time, or having big losses from real estate, consider doing Roth conversions. You move money from a traditional IRA to a Roth IRA, and you pay the taxes now when your income is low. So that allows for tax-free growth forever. And this works beautifully during career transitions. And I told you that I would give you some insight in what we're currently thinking about in reducing our taxes. So we currently use oil and gas. We have not yet, something on my to-do list, people, set up our donor advised fund, but this is one of the ways that we also want to make our charitable contributions. So oil and gas, we've done the Roth conversions in lower income years. And this year we are really considering doing the short-term rental loophole and also purchasing businesses that we can work in and have that active material participation. With this purchase of a business, I'll have to spend, and I say because I'm probably going to be the one doing the work, 500 hours within the year, which breaks down to about 10 hours or less every single week, which I think is definitely doable in this job. And we will take the bonus depreciation from some of the big equipment of what we're buying. So if you want to hear more about this journey, it's coming. It is coming, people. I am speaking it into existence. We are on our way to purchase this business. So subscribe to this channel so that you can get all of that inside scoop on this journey. So here you have it. Here are the creative ways that you as a W-2 earner can legally reduce your tax bill while building wealth today. I want you to comment below and let me know which one of these surprised you the most and which one you're going to try next. If you have any questions, then let me know in the comments. Let me know which one you want me to break down in more detail. I am happy to break all of these down for you. And if you're a high income professional and you're looking to start a side business, to invest in real estate, or to just keep more of your money, but you don't really know how, that you want someone to help to coach you through this process, then look in the description and click the link to schedule a call with me to see how we might work together to elevate your finances and reduce your tax bill in 2025. All right. Well, I thank you for watching and I'll see you in the next one. Bye-bye.